Now, as we always like to look at the 4-week rolling average, where are the things happening in general when we start talking about different flows, you can see that there is that sizable drop. So we went from 15.358 million barrels a day of demand last week, and now we're at 13.454 million. Again, 15.3 was too high, 13.4 too low. So it's just a matter of where do we settle out, and we continue to say that we're going to be very close to that, that sub 15 million barrel a day number, something closer to 14.8, 14.9. So really below what we normally see at 15 and a half into 16. It's going to be something a bit closer to where we were when you look at 2021. On some of those averages. Now, you can see in 2021, we continue to see some of the strengthening, and we're not really going to get that because 2021 had the benefit of distillate. You had the benefit of a huge demand surge from the trucking side, which then carried into 2022. We don't have that benefit. And that's why we're just going to see things kind of stay below that 15 million barrel a day line. We'll likely get another spike above. I'm not saying that we're not going to get some of these spikes. It's just when you look at the average, that 4-week rolling average, we're going to be under pressure just because of the level of activity or lack thereof, especially when you look at the distillate and the gasoline front as we go through the remainder of this core season, and then as we pivot into the end of summer. So distillate had a build of 4.81 million. That's still 18.2 million below the 5-year, but it's 4.4 million over the year-over-year. So again, we're starting to get a little bit of that love coming through. There were builds across the board. Pad 1 desperately needs it, so it's nice to see a bit of an increase. Pad 2, again, saw a pretty big acceleration to the upside, and it's with a lot of activity. And the question's really going to come down to where are their crack spreads given the increase in price of the feedstock, and then where is essentially their end stock going to get priced at this point in time. Imports came down slightly, 42,000 barrels a day. You can still see it's right around the 5-year. Realistically, it's going to be difficult to see the U.S. compete to pull in some of that disty. A lot of that is still going to go into the European market. We'll get whatever we can on colonial, but we don't see too much on an import side. The shift is really going to be what are exports doing, and what are product exports from Pad 3 going to look like versus colonial. And right now, I mean, the ARB is wide open, sending product from the Gulf of Mexico into Europe, and we'll talk more about that as we get into the segment 3. When we look at diesel cracks, we had a nice little bounce. It pulled back just a touch, but realistically, we're still at a stronger point than we were. Our view is that we're going to get that bounce and then that start to kind of see that fade. Right now we're seeing some of that strength. A lot of that is going to be driven based on the benefits of the exports. We do see builds accelerating just because we don't have the demand when you start looking at trucking and the commercial or that manufacturing activity. But the balancing act is going to be the export market. Where is Europe? Where is the U.S.? Where is that east to west, west to east, Suez arbitrage? And that's really going to dictate kind of how strong can this diesel crack get. It's obviously better than it was in 19, 20, 21. The question is going to be kind of where are some of those key pivots going forward. Pad 1, nice little love coming through, but you can see we normally get builds this time of year. So it's the rate of change is good. But the rate of change here is very similar to what we've seen in the past. So again, we're not closing any gaps at this point where we really need to see that gap close, unless we're going to have a much bigger problem as we get into heating season. Pad 3 balanced out right around the 2019 levels. Realistically, this is going to come down to, because we do have an increase in refinery utilization rates that will put more distillate in tanks. And then the question is going to be how much of that it gets pushed out into the export market to help this balance. and then how much of it goes into the colonial versus the storage. Where is the arbitrage? So right now, as we were saying before, it made sense to put it into storage and not to export it, which is why we got that massive bump. Now it makes sense to export it, not to store it, but you've increased run rates. So instead of drawing back down, we're just going sideways. And that's going to be an interesting one. And based on what we're seeing, the exports are going to be there, which is going to keep storage on a sideways basis, maybe a little bit of an increase just because of the increase in activity on the refining side. But again, those exports are going to be important. They obviously are lumpy, so we could see a big swing, but that's why we're looking at big swings up or down. We're going to look at that average, and you can see we're starting at average, that kind of flatlining basis, which I think is likely. Obviously, we had a massive drop in activity. As you can see, we normally have this drop. It's seasonal, just like anything else. People don't do a lot during the 4th of July holiday. So we will get a snapback. The thing we've been saying, it's going to stay below the 5-year average. We're going to stay at just the lower end of that cloud when we look at distillate demand. The market demand index, you can see here on the trucking side, starting to roll back over a bit, coming at 31.47. So when we look at some of the different flows, again, we see some of these pressure points as we're going forward, which is just showing some additional slowdowns that we've seen in the near term. But when you look at the incoming volume, we've had a nice little pickup. Now, the question is this coming a little bit earlier? Because typically we get some increases as we go into, let's call it back to school, fall buying. So is this coming a little bit earlier and people are taking advantage because shipping prices have come down, the supply chain has improved? Right now there's really not much to say one way or the other. We had a nice little recovery. We want to see how this changes going forward. If anything, just based on what the boats are saying, is that we should go about sideways at this point. But again, this is going to be an interesting one to watch that we want to look at, because container imports bound for the U.S. at the point of booking are showing some signs of life. Is it a head fake or is it peak ordering has shifted earlier this year? Retailers enjoying strong dollar taking advantage, or retailers have destocked and replenishing with fresh inventory. We don't see the destocking, so we don't think that's the case. Realistically, we would say that peak ordering has shifted a bit. So I wouldn't say this is head fake. This is real. Like, we're seeing some of these numbers. I think this is much more of peak ordering and the strong dollar. So why not try to take advantage of that? So again, so we do see this leveling off a bit, especially when we start looking at some of the broader things on the Logistic Managers Index. The composite measure is sitting at its lowest level since data tracking began in 2016. A sub 50 indicates contraction in the U.S. logistics markets, which include transportation, inventory, warehousing. So again, that's why we don't think it's more of a destocking, because you're seeing some of these pressure points. So again, that's why we're a bit hesitant to say that this is a big ramp up in activity. Oh my God, things are better. It's more along the lines of, well, a bit of peak ordering, which means that things will likely get worse again when we normally start to see that a little bit later in the year. And that's going to be a bit of an overhang. When you look at rail here, you can see that rail came down 2.3% on the total carloads. Grain, forest products continue to be a problem. Metallics, motor vehicles continue to be supportive. And then intermodal had another drop. As we were saying, things were going to get a bit better, but by no means where they were last year. You're still going to see some of these pressure points. You're still going to see those under pressure. So again, we don't see, this is showing another reason why it's really not restocking. If it was restocking, we'd see this moving on multiple levels. Again, it's just more along the lines of peak ordering being pulled forward, taking advantage of that dollar. Now, when we look at total planned containers coming through, you're seeing some of that increase reflected in this week, in week 28, week 29. But then you see things drop off again in week 30, which is going to be an interesting one. Total planned containers have actually fallen down a bit. It went from 900, it was about 997,000. Now it's 996,000. It was 197,500. This is 196,500. So again, you're seeing A little bit of a slowdown, but not a huge drop, just a bit more of that flatlining. And that's where we continue to see some of these adjustments. It's going to be interesting to see, does week 3 gain traction, or are we starting to see kind of the end of that ramp up in activity that we had initially saw? You've heard us talk about the heat dome before. Here you're getting it again. You can see that essentially Texas, New Mexico is going purple. Or for those that are fans of Spaceballs, going plaid. It's turning a color that they shouldn't. For Giant fans out there, think about the face of Coughlin during the Giants playoff win in Green Bay. So where it was a very unnatural color. This is it's going to support natural gas demand. You're going to see more of that power burn getting pulled through. And again, this is going to be an interesting one to watch because it could start to impact refinery utilization rates, because it's difficult to run in some of the heat or to the same degree. So that's going to be an interesting one to watch as well. It'll also keep people a bit more indoors, not to say that you're walking block to block in Houston. Gasoline had a very small draw, something that wasn't, I think it was like 7,000 barrels. So it's still 16.6 million below the 5-year, 5.5 million below the last year. And the draw was really driven by Pad 1, Pad 3. Pad 1 had a drop of 1.26. Pad 3 had a drop of 1.56. Pad 2, though, we continue to see products getting built up in Pad 2. So again, that's where we start looking at margin, what's going into a tank, what's coming in. That's going to be an interesting one to watch. Pad 3, we had a nice little increase in exports. So again, that balancing act on the Pad 3 level. But as activity, remains a bit depressed and refinery run rates increase, we do expect to see a bit of an increase in storage, which is actually fairly normal when you look at 17, when you look at 19, when you look at 22. So we do see a bit of a bounce in terms of some of these builds in general. Imports came down slightly, 70,000 barrels a day. That's just 56,000 below the 5-year, 66,000 above last year. And based on what we're seeing, we do see additional flows. We do see more product being imported into the U.S., especially from Europe. There still remains to be a near record level of gasoline, which will keep that flowing over. And that's going to keep us elevated, moving us closer to that 800 to 850,000 barrels a day of gasoline coming into the market. When you look at blending components, they had a nice little drop. So remember, we talked about the importance of weighing blending components versus total. So we had a draw of 2.18 million. That's 14.2 million below the 5-year. But when you look at finished motor gasoline, you had a build of 2.18. So the question is, was the blending just going into the finished motor gasoline and getting ready for that dissemination into the market? So you have a little bit of that counterbalance, and it hasn't had the same correlation it has over the last couple of weeks. I don't know if it's blending, timing. There's something there which we're going to dig into a bit more, but we don't see this having a big draw as we go into next week. And if anything, a bit more of a sideways move. If anything, a bit of an increase, just because that blending has already happened in some parts. There hasn't been too much of a change. We haven't gotten the new data yet for North America, Europe, Asia Pacific. We do expect to see a bounce in North America, similar to what we saw in 2022. Again, that bounce back up. As you can see in 22, you had that dip and then that recovery. We'll get that recovery. We just don't see the recovery going above what it was prior to the drop. Just kind of coming back up. Europe typically continues to slow. We don't see it slowing to the level that it did in 21 and 22, but just more of a level off, something, let's call it 8% below 2019 levels, not this big collapse. While we do see Asia Pacific maintaining some of those headwinds as we go into the peak heat months, if you will. So it's just going to be below average. Then when you look at Gas Buddy had targeted this past week at gasoline demand at 8.66 million barrels a day. When you look at EIA had, it was about 8.7. So pretty much in line, in terms of what Gas Buddy had. Again, even still, the EIA is still a little bit higher. So we do have to factor that in. So we do see that continuation. I'm sure Gas Buddy is going to show, a sizable growth, something north of 9 million barrels a day of demand as we go through this week. And that's something that will likely be reflected again in the EIA. When you look at gasoline prices, gasoline prices are starting to catch a slight bid, nothing crazy. You're starting to see it level off, a little bit of that turn up. Obviously, crude prices going back up. We have Brent over 80. You have WTI over 75. So again, that's going to kind of put a little bit of a bump at some of these bottom levels. When you look at the comps, and this was an interesting chart done by Gas Buddy, this is comparing what has happened in terms of deflation, inflation, and year over year. So when you look at some of the year over year comps, you have some sizable increases of gasoline dropping out. And that's, again, why we're going to, gasoline essentially is just saying that the gap will narrow to less than $1 a gallon next week. And so the year-over-year gasoline figures won't be pulling CPI down as hard when you look at that balancing act. As you get some of those sizable numbers dropping out, comps get a bit easier. And that's why when you look at the CPI, which we're going to talk about tomorrow in the Econ show, the CPI is a bit, it's not as good as the headline looks, but that's something that we're going to talk about. As we mentioned, gasoline demand had that sizable drop as we expected. We didn't think it was going to be as big of a drop as 2022, just because we didn't get the same increase ahead of July 4th. So again, you're getting that balancing act on both sides. We will get a little bit of a love here, moving that back up to at least that 10-year average, which is that light blue line. And then we'll get a little bit of that trend. But again, it's going to be a very stable number, that 9.4, 9.5. And we're just not going to see this big spike. We might even see a little bit less. That's something that we'll assess as we get through it, just because interest rates went up again on the credit card side. We finally saw that a fully negative red book, just looking at real-time retail sales. Again, like things that are showing us that we're just not getting the activity we normally get. And that's something that we think is going to weigh on that summer activity, which is why we think things are going to be a bit disappointing. Propane-propylene build of 2.67 million, well over the 5-year, the year over year. You can see going back since 2015, this is the highest or fastest we've seen. This is going to keep a lot of pressure in terms of pricing. Why we think it's going to be there, the pressure is going to be there. And the problem is the export market is going to start to crack. It's not yet. I'm not saying it's going to happen yet, but you're going to start to see this pressure, and that's going to start to weigh on our exports. And as that starts to happen, not now, but this is more of a September and October comment, you're going to see some of these pressure points. And unless we get some meaningful increase, or at least an earlier winter that's going to pull some of this LPG in, it's going to be a very difficult time as we get into the at the end of Q3, beginning of Q4. Jet had a build of 260,000 barrels, right in line with the kind of normal. And you can see that had that sizable drop, as we've been saying, 1.55, 1.65. That's going to be the range. When you look at ahead, you can see that things are fairly stable. Obviously staying at the higher end when you look at the Americas, when you look at totals. There's a little bit of that drop down in general versus the beginning of July to now, but again, still fairly stable. There's nothing to say that we're going to have any of that drop. Some of the delays have gotten a bit better, or cancellations, I should say, which is exciting for anybody that has been flying. On the TSA level, as we've been saying, it's just going to marry 2019. Because of where the holiday fell, you can see that the dips are adjusted, but again, still kind of moving in normal levels. So we don't see too much of an adjustment. Some of the bigger issues that we've been talking about when you look at eating out, eating out is now 4 to 5% below what it was. Global, 3 to 5%. And this is where I think you're starting to get some of that bigger impact into how are people spending their money? How are people starting to tighten up a bit? And I think this is just another example of some of that slowdown. Net, as we've been saying, we're going to get a seasonal increase in demand. It happens seasonally. We just don't think it's going to get back to where it was pre-COVID. Even 21 levels, 22 levels were a bit higher. Like there's definitely some pressure out there, not only just on an economic basis, but just in terms of the activity levels, which obviously on the distillate side is economically driven. So those are some of the key points that we wanted to highlight. In the next segment, we're going to go deeper into some of the different flows, some of the different physical numbers, where those spreads are, and how that's going to impact things going forward for really over the next couple of weeks.